Welcome to the ALX Show, your premier source for DFW real estate data and insights. Let's get to it. Hello, Josh and Patrick, and welcome back to another episode of the ALX Show. I see Josh was just diving into the camera there. I love it. It's so good to see y'all. I'm so excited to talk today because there is a lot of data that has come out in the last 7 days. We didn't record earlier this week, just after the jobs data that was released 6 days ago on Friday, October 4th. And so I want to hear from y'all about that labor data, but then there's also some new inflation data that has come out just this morning. And so I want to touch on that. But also you were just describing some, basically some anecdotal data that you're seeing on Dallas properties, one in particular, but also it's kind of a story of different things that you're seeing in the market. So a different, I don't know how you would want to call it, but like price points in the residential real estate market and how that's trending because of what's happening in the mortgage rates and interest rates. So the theme I think we're hearing right now, and we've talked about this before, but the theme is everything is so volatile right now. And so there's investors, buyers, sellers, a lot of people are just sort of sitting on the sidelines waiting to see what happens, especially with, like I said, this data coming out, but then we've got the election coming up in just a few weeks. And so there's just a lot of hesitation, and as a result of that, a lot of volatility. So I want to hear from y'all. You have been scouring the data over the last 6 days, and especially this week. So tell us, what's the latest on the jobs data, labor data that came out on Friday, and then we'll dive into some of the inflation data today.
You know, the best way to describe it to me is kind of a false start. Like, we had all this positive momentum, I mean, towards lower rates, and then the jobs number comes out, it's better than expected, and everyone takes a pause. You know, those that were thinking, 50 basis point cuts in November and again in December now say, no, that's not happening anymore. You got 25 is more likely, all because the report made the labor market appear strong, resilient. They added a lot more jobs than what people anticipated. So it's just kind of more of the same, right? For this year, we've seen just a lot of volatility. We see a report that indicates one thing, and then another, macro level report comes out, and it's telling a slightly different story. So it's a volatile time. Like I said, it's hard to really nail down a trend. We've got a lot of money in the economy, and it's doing things that we haven't really seen before because we've got all this government spending. We had the stimulus, and we have continued government spending. And it's just really hard, to find any sense of clear direction, just because this is new. We're navigating kind of a new environment. Plus, we got the presidential election. I mean, what do you think, Patrick?
Yeah, I mean, it's hard to take any one jobs report with as volatile buzzword as they've been over the last year. Yeah. You can ride the highs real high and the lows real low if you get wrapped up in it. So stepping back and just taking a big picture of the trend line and trying to get an idea of where we are and putting all the different data pieces together. And, initial jobless claims came out today, which would really run counter to the narrative of the labor report from last Friday. I mean, they were way up above expectation, not only in the initial claims, which you can explain some of that away with impacts from Hurricane Helene. North Carolina had a huge spike in jobless claims, and that doesn't even include the people who don't have internet yet to file claims. I mean, expect that to keep going up, but the continuing claims were higher than expected too, which, indicates that it's not necessarily just a blip because of bad weather or whatever else. So it's, taking a step back and saying, how do we fit all this together? And then, I mean, Fed's asking the same question too and driving their policy. So lots going on.
Yeah, I think it was productivity was higher in the jobs report. Is that right? I mean, that's always a good thing. Am I right on that? Yeah. So productivity was higher. I think just slightly. That's why I'm asking. Is meaningfully higher? I don't know, but it was higher. So I mean, anytime that you've got more production through the labor force, then that's good. You're getting more output out there. Then that's good for inflation. right? If you're just putting more out to the market. Yeah.
Yeah, maybe said another way, instead of volatility, it's almost as if people can't find the story. What is the story of what's happening right now? I can't make sense of it. Like you said, clarity was maybe a way to describe it. Like people just, it's not clear what's going to happen in the future, and therefore I can't make decisions. So to your point, to put a finer point on and catch some listeners up that maybe didn't see some of the data that came out. So on Friday, October 4th, non-farm payrolls increased by 254,000 in September. Unemployment rate falls to 4.1% from 4.2%. And then there's hourly earnings rise 0.4%. And then it said average work week 34.2 hours from 34.3 hours. This is from Reuters. But then today, we had initial jobless claims for state unemployment benefits increased 33,000 last week to a seasonally adjusted 258,000 for the week ended October 5th. And so economists polled by Reuters had forecast 230,000 claims. So that's about 30,000, or almost 30,000 claims above what economists thought, which to your point was kind of inverse of kind of some of the data that we saw on Friday. So it's just sort of a mix. I don't know what to say about it.
Yeah, and I mean, I don't want to take it if we're not ready to go there yet, but if you want to complicate it even further, that you can throw the inflation narrative
Go for it
in there too. And
okay, what's that story? What's going on there?
So inflation or CPI came out this morning and was, I mean, all the headlines are going to read hotter than expected or kind of grandiose language. It wasn't, I mean, we're talking a couple basis points above what the expectation was. And so, bond market reacted accordingly and yields have kind of shot up and as making some, Fed members even second guess previous policy decisions too. So I think there's, just every month it's riding the highs and the lows, and, inflation last month can look like it's going in the right direction, have a little bit increase this month, and just acknowledging that it's going to be a bumpy ride on both sides of the Fed's dual mandate, employment and inflation. And so, I mean, this inflation report, not to get too far into the weeds, but food, which has not been an inflationary item for well over a year now, kind of spiked back up, I think, from maybe 0.1% last month over month increase to 0.8% this month. And
wow.
I mean, that includes a 10% month over month increase in the price of eggs. Just wild stuff.
Huh.
And you just attribute that to a wild bird flu season that really limited supply. I mean, stuff like that is, not necessarily a trend that, you should be making predictions about where inflation's headed. So there's actually a lot of good news in the inflation report too.
And like we talked about, I mean, the food stuff, that's what everybody feels, right? You go to the grocery store, that's where you feel it the most. You go out to eat, and that's not all just the food price. There's a lot more than wages and everything. But it's also, like we were talking about, it is fluid. So we're hopeful that just as prices go up quickly, you can have a few things change and those food prices can come back in. So we're still, I think, on the right path. I think everybody would agree where inflation was and where it is now is a much better situation. Over the last several years, it still has gone up, considerably, and it hurts. But I think we're moving in the right direction. I think the bond market reacted to what they think the Fed's going to do, right? So you price in the expectation that you're going to have more cuts. Then all of a sudden you get this news that makes you think, oh, maybe we won't. And, and then you lose some of the value because you were expecting something that now looks like it's not going to happen. So there's just stuff that was already priced in that's now being priced out because data is suggesting that it's going to take a different route, which means less Fed cuts. Not maybe less in number, but now we were thinking 50, now it's likely 25 basis points. And that affects everybody in real estate. What does that mean for us? Well, it means our borrowing costs are going to be more expensive because it keeps the 10-year elevated, and if the 10-year is elevated, it keeps mortgage rates elevated. And we talked about earlier 6.6% mortgage rates, where 2 weeks ago we were looking at closer to 6.15. So that's a big shift. And if you're looking to buy a home, then you're like, hey, if you don't have to buy, then do you really want to, kind of jump in now and have to deal with this like seesaw, rate effect? I don't think so. I mean, unless life circumstance like dictates that you go make a move, I think a lot of people are seeing it out, and that's what we're seeing, especially like here in DFW, pending homes or listed homes that are they're sitting for longer. Pending home sales are down, closed home sales are down. Prices are coming in a little bit, but I think it's just because people are just thinking like, hey, rates are going to come down, and we're still in this place where they're just kind of like moving up and down. Let's just wait. And let the rate cuts happen. And then maybe in the spring or in the summer, we get down in that 5-something rate. And now we feel more comfortable making a move. So it just transactions overall in the real estate world, it's just difficult. It's just difficult because everybody is just a little bit, weary of doing something too soon. And that's kind of what it feels like.
Yeah.
It's like, just wait. It seems like that's just the prudent advice if you can.
We've been talking a lot about why the commercial side has also been really slow transaction wise over the last few podcasts. And this is like almost the best example you could imagine. So 2 weeks ago, when the 10-year treasury went down to 3.6%, you could get a quote from Fannie Mae or Freddie Mac or any long-term fixed rate provider. And we're talking about the multifamily world here, but that was, under 5%. And it led to a slew of activity, primarily on refinances. I'll get to that reason why in a second, but primarily on refinances. And it created a big backlog. And unlike a residential mortgage rate, where you go under contract and you're probably locking within a couple of weeks.
Yeah, the quick mortgage providers can lock you in like 10 to 14 days. I mean, really, really quick. If you got all your stuff ready to go. Otherwise, 30 days, maybe. So I guess to Patrick's point, it's way shorter than the commercial process.
Yeah. So the commercial process, so one, you've got to wait until you get an application and which effectively a term sheet from Fannie or Freddie. And that was taken at least 30 days because of the glut of activity they got in. And then you've got to go through the closing process, and they've got to document all of their underwriting and get everything from you. And that's probably going to be another 30 days or so. And then at that point, once you get the all clear, you can lock your rate before you close. So you've got, most times it's 60 or so days from when you get a quote that says, hey, we can get you a rate under 5 to where you're actually going to close on that rate. And in 2 weeks, that rate has probably gone up 50 basis points. So
I mean, what does that do? Like, talk about what does that do to leverage?
Yeah. I mean, it's going to reduce your loan amount. So if you thought you were going to get a certain amount of cash out or be able to pay off a certain loan amount, you're not going to be able to do that or get that amount anymore. And it's the reason why buying and selling transactions haven't happened, is because nobody's going to enter into a contract with 2 months of potential wild swings in their interest rate. It's going to change the economics of their deal. And so everyone is offering really conservative values on properties that a seller doesn't want to accept. And so that's why we have continued to say we need some calm in the market and some, peace about future direction that reduces this volatility so that buyers can ultimately get more aggressive again.
Yeah, and people want to buy. Like, people want to transact. We hear it all the time. We hear it from brokers. Like, there's a lot of buyers out there that are ready to move, but it's got to make sense. And the only way it makes sense is if you've got you've got more clarity, like we said, about where you're ultimately going to land. And the debt is the biggest piece of any deal. You're talking about, for most deals, 70 to 80% of the capital stack is coming, through financing. So when you have a deal that, goes sideways because your debt increases, you've got two options. You can go renegotiate with the seller and maybe get a lower price so that you can, all of a sudden the economics work again, or you've got to go raise more equity. And so in either case, it's not, and if you're raising more equity, then, it's going to be more, it's going to put more burden on the project, on the cash flow of the project. So It's in the exit. I mean, it impacts it in a big way, potentially depending on how much you have to raise, but it's not ideal. So if you don't have to deal with that, either of those two things, and you feel a lot better about signing up a PSA and going under loan application, which isn't free, by the way. You got to pay for the process to start. That's another thing. There's also earnest money involved, so you can see why it just, people are just hesitant. People want to do deals, and there's good deals, I think, to be made out there. There's strong properties and strong markets, especially here in DFW. But if you just don't feel good about where that debt is ultimately going to be when it comes time to close, then then it's really hard. It's hard to move forward.
Yeah. And it's not just on the commercial or multifamily side. It's also on the residential side. We were talking just before we hopped on that there's a house that you've seen in the Dallas area or some data in the Dallas area, but there's a particular home I think we were talking about. But between this 500,000 to $1 million price range, you've got this kind of odd behavior. I don't know if that's a good setup, but explain a little bit more about some of the data that you're seeing and what's happening specifically in the Dallas market, especially in that price range.
You're talking about the price range that oftentimes is most sensitive to the rate. On the lower end stuff, it's still you still feel it. It still comes into play, certainly in the underwriting. But on the lower amounts, the rate movements maybe is not as significant. And then when you get into like a kind of the medium tier, the average home price in DFW is in the 400,000. So we're talking about maybe below that, where you're still having a lot of activity, but just slightly above that, up to $1 million is where we're seeing things start to stall out. And that's where you get into these bigger loan amounts, and they're really impacted by these higher rates. Once you get above that number, you've got a lot of wealthy individuals that have the ability to pay a lot of cash, if not all cash, for the property. So I mean, they don't care what the rates are, as long as they feel good about the house and they feel like it's priced fairly, then they're good, and then they can refinance or they can get cash out when the rates come back in. So the people that are really getting squeezed are kind of the ones right in the middle there. Like I said, that 400 to $1 million, especially right in that 750. It's just hard. I mean, those higher rates, you really start to feel them on your monthly payments.
Yeah, we've gotten some feedback from folks who flip homes and are in residential real estate all the time, searching for opportunities to remodel and exit. And that's pretty consistently been feedback that we've gotten, is that activity is really strong on the lower end, less expensive end. And then if you're going to kind of step up into the luxury world, you've got similar exit ability that you can kind of forecast. And then in that little middle tier that Josh is talking about, some things are just sitting there for a little bit longer compared to the other two groups, which is, an interesting piece of data for us to think about when we're, extending capital to folks like that.
Yeah. And the lower end stuff, I mean, say it's becoming more and more rare. I mean, that stuff is what you deem affordable, maybe in like the sub, even though the average price in DFW, like I said, has been creeping up. Now here lately, it is coming down a little bit. Like interest rates are having the effect. I mean, people are stepping back, so the homes are sitting longer on the market, so their prices are coming in. It's obviously not significant enough to really move the needle, but they are starting to drop. We saw that in the September numbers.
What you're saying that the lower end of the market is more rare, you mean just like homes in general in DFW are just getting more expensive? It's hard to find something that's on a lower end of that price range. Is that what you're saying? Yeah.
Well, and people just from a true affordability standpoint, I mean, if you can find it in a good area, and a lot of these homes are, they're pushing further out. You're getting outside of DFW, but people are willing to drive because home prices have gotten so high, and overall wages have not been able to keep up, with the pace of inflation. So it's just, those lower end, or if you can find a nice home in that lower price point, then it's not going to last long, because that's what everybody's like hoping to find, right? A decently priced or sub $400,000 or $500,000 home in a great location. And I mean, those are difficult to come by. So it makes sense, even though that there's still a lot of times are going to be rate sensitive. It's a better situation maybe if you like the home, right? It's just a more affordable situation.
Yeah. My wife and I always talk about maybe we'll just move to Kentucky. She's got some family up there, and you look at home prices, and it's literally like a third of what we pay here in DFW, and it's like 100-degree weather. Maybe we can skip that and find a cheaper home. But it's tough.
It's a great point. I think that's a good plug for DFW, and there's a reason for that. I mean, lots of people are moving here because the opportunity is so great.
It's amazing. Yeah, we talked about that a lot.
Yeah, there's not enough housing. That's what's pushing it up. Like we've got this huge, population build, and we don't have enough housing to support it. I mean, we saw the huge apartment supply numbers over the last couple of years. Those are way down now. But we had a massive, supply gain on the multifamily, historic, and new homes like single family. I mean, they're starting to tick up. You see them they've had a nice, healthy growth, but they haven't been able to keep up, and they keep getting like the start, stop with whether it's the great financial crisis and to that number going back, but it matters. It takes a while to turn the engines back on, or COVID and the higher interest rates. So it's just we haven't had like a sustained run of like high residential productivity.
Yeah. No, yeah, I didn't mean to say DFW is not a great place because I love I love being here. I love Fort Worth.
Take the opportunity to put that in there. But yeah,
no, it's right. It's right. Yeah.
Your point. Yeah, I take your point. It's a good one. Yeah.
I love being here. We've talked about so many times that DFW is just one of the best places to be. As far as economy, you can buy land. I mean, house prices are more expensive, but there's still land available for a lot of people, and there's just so much here, jobs and schools and all kinds of things. It's really amazing. But yeah, it is. Housing affordability is a huge issue. And that's why you're seeing it in the national, presidential campaign. I mean, one of the top headlines is housing affordability. It's just something that a lot of them are talking about because it's such a big issue, especially here in DFW, North Texas.
I think it's important although it has been a rocky run, like Patrick mentioned, we still think that 2025, 2026, there's great opportunity and potential. The Fed is still, on track to bring rates down, and that'll have a positive effect across the board on all borrowing rates. So it has been, it's been a rough several years. Like we all are very aware, but we do believe that it is starting to kind of cycle back into a better market to do business in, just for real estate. So we're excited about it, and I think that 2025 is going to be a good year. I think we're going to look back, a year from now, and be like, yeah, but we don't even remember, we learned a lot. It was hard, or whatever, but now we're back in a sweet spot. So we think it's coming. We can't predict when, but we do believe that transactions will turn back on here. 2025.
It's funny, and I guess just to cap it off, and always have to take it back to numbers because that's what the dorks do. But we've like pretty consistently. I won't say we. I guess I'll own this one. I've thought for a long time that the risk of inflation reaccelerating, just haven't really seen it. And I know that a lot of really smart people would disagree strongly with that. But the number that we keep coming back to is core inflation X shelter. So if you took the really strange methodology of how they calculate the annual inflation for rent out of the equation of core shelter, even with the report today, that number is 2.0%. And so my belief has been for a real long time that the inflation numbers are almost solely driven by housing at this point. And as that continues to come down, it had a big jump today compared to the little mini panic we all had a month ago about shelter costs. So as that continues to come down, and we know that it's going to, it's going to be really, really hard for inflation to meaningfully reaccelerate. And so that's why we're pivoting all of our focus to the jobs report. And, at the end of the day, strong jobs report shouldn't be a bad thing. I mean, we all want interest rates to be lower and housing activity to be spurred on, but we want a strong labor market too, because that's has to be in place for everything else to thrive. So that is kind of how I'd summarize all this together.
Driven by shelter and eggs. So buy chickens, buy a house, and you'll be okay. No, that's great. That's super helpful. Again, that's something that I wouldn't know. I mean, I can read, the Wall Street Journal, but I'm not going to pick apart the composition of the PCI numbers or anything like that. And to have you guys in there in the inflation report and really digging into it is incredibly helpful, because I don't have time or the expertise to do that. So, so again, I appreciate y'all. I mean, the last year we've been doing this podcast, I keep getting this sense that there is a greener pasture. There is a brighter horizon ahead, and it's been pretty tough this year. It's been very rocky and up and down. Still is. Q4 is probably still going to be a little rocky, but I think, going into 2025, it's going to be pretty smooth. That's the gist that I get. Is that more or less what I'm hearing from y'all? That it's going to be okay. Let's say in 6 months, 12 months, we're going to find some kind of I don't know, easier, smoother path.
Yeah, I think that's fair. I don't know how quickly into 2025, and we're hopeful as soon as possible. I think economic policy is going to play a huge role. It's going to be really hard to rein in government spending like significantly soon. I mean, I know there's a lot to that, but if you can implement some supply side economics and then try to get a handle on some of the deficit spending, then this could turn around really quickly. We're hopeful that happens. We, like Patrick said, we're seeing inflation. It's coming down. The Fed has already started and will continue to cut rates, barring something unforeseen, which we can't see the future, so something could happen. But based on what we can see, we think that 2025 and beyond we're gonna kind of come out of this tough part of the cycle and be back on the way up.
That's great. Glad to hear it. Well, again, thanks so much for looking at these numbers this week. Next week, we will take a look at some more reports and headlines and report back to you. But yeah, listeners, I would love to hear feedback or anecdotes that you've seen on your end, whether you're an investor or just a homeowner, just things that you're hearing and anything that these guys can answer, in our newsletter, in the blog, or on social. Would love to hear it. And so if you have any questions, find us at alxrealestate.com. And we'll talk to you next time. All right. See you guys.
All right. See you, Brady.